Well, we have some very special people here today. This is the Laws, Rules, Regulation, and Compliance for ICOs panel, Fraud or the Future? I feel like that's the question everyone's asking, right? My name is Amy Wan. I'm founder and CEO of SageWise. I'm a securities attorney by training, but we are a dispute resolution infrastructure for smart contracts because back in 2017, over $1 billion in value was lost in smart contracts just from various reported hacks. So we're basically trying to bring transactional confidence and certainty and a little bit of recourse into the space. And I'm gonna go ahead and let my panelists introduce themselves very quickly and tell us a little bit about what they do.
Good afternoon, everyone. My name is Michael Homeyer. I'm with the firm of Homeyer Law. We are a 6-attorney boutique securities and corporate law firm with a special expertise in helping issuers raise money from investors through EB5, crowdfunding, and now coin and token offerings. We have worked on roughly 400 EB5 projects in the last 9 years, probably close to 100 crowdfunding projects, and we're adding the ICO work on because it does seem like there's a shortage of transactional securities counsel and advice going to issuers now that the SEC has said, hey everybody, play by the book, you ought to treat everything as if it's a security. Michael Homeyer, securities lawyer.
Hi, I'm Kelly Bergendahl. I'm from Ascendiant Capital. We are a registered broker-dealer, registered under both SEC and FINRA. And I'm up here to talk about the same exact thing. I feel very strongly that there's a lot of people that are in this blockchain community that are being somewhat misled or being told that it's okay to do ICOs in the wild, wild west and that nothing's gonna happen from them. And it's frustrating, and especially with young people who could be changing their lives forever by making that kind of mistake, so.
My name is David Silver. I'm from Silver Miller in Miami, Florida. I'm actually really excited because Amy said there was about $1 billion of hacks and frauds. Well, I currently represent over $700 million of people who got hacked in the last year. I have the largest ICOs. I have the largest class actions in the space. I am presently suing Tezos, BitConnect, Gigawatt, Monkey Capital, Coinbase, Kraken. 2018 is going to be the year of litigation exchanges. So I can tell you I'll be leading that. We're going to, the ICOs.
Do you want to raise investors for that, David?
This is the gentleman. This is exactly the reason why you want to use an SEC attorney and a broker-dealer, is to stay away from this gentleman.
And nobody wants that to be true more than me. I tell everybody, and this has been my new pitch. It's really simple. You learn this in kindergarten. Play nicely with others, don't steal someone's toys, and do what you say you're gonna do. Yep. And if you do that, there's nothing wrong. Then everyone can have, we're in ICO 2.0. ICO 2.0 is much cleaned up. It's very different than it was a year ago. And you gotta hire the right lawyers. They're gonna give you good advice. They're not gonna lie to you and tell you your token's a utility token and then take payment in the form of the utility token, claiming it's not a security. Now, the one man who laughed at my joke, it's not really a joke because I'm gonna be the lawyer who's suing those law firms who took the utility tokens as security payments, because I think all those people should be indicted and go to jail with those who stole the money. So we're going to do a lot of cleaning up. I'm happy that the SEC this week came out, did the subpoenas. I personally thought the price of Bitcoin might go down and cryptos would go down. I'm pleasantly surprised. The community actually is embracing a little regulatory work, and I think that's good for everyone in this room.
Cool. All right. So let's start off with the basics, and then I think we'll accelerate quickly to more advanced topics. Michael, I feel like someone somewhere made up this weird distinction between utility tokens versus security tokens, which to me is this false dichotomy. Can you explain to us what is a utility token, what's a security token, and really, aren't they not mutually exclusive?
No, I actually can't explain the difference. Practically speaking, there is no difference, really. There is a technical difference. It has to do with whether people are giving money in exchange for an increase on their investment, usually through the efforts of other people. That's a nice legal-ish definition. But the SEC has come out and said toward the end of last year, look, we'll know it when we see it, but we haven't seen one yet. That is a utility token. 99% of what we see is a security. You ought to treat it like a security if you're doing a coin offering or a token offering, and just, behave yourselves like everybody else does in this business. Now, I've been doing securities law since I got out of law school, which suddenly was an extremely long time ago, but in 34 years, things haven't changed in the sense that the government sees people giving money to others and getting ripped off. And the government has made a determination toward the end of last year that they wanted to do what they could to stop that, or at least slow it down. And instead of spending all this energy saying, how can I be a utility token? How can I be in that 1%? How can I sneak my way out of this pronouncement by the SEC? The answer is you can't. So why don't you just embrace it? The SEC has made a policy decision based on how do you maximize protection of investors. The way that you maximize protection of investors is to treat the investment opportunity as a security. And you ought to know that what that means under the law is if you're selling an investment opportunity to a prospective investor, you have to give that person full disclosure of all the material facts about that investment opportunity before they give you their money. Now, to the extent that the SEC may be technically wrong and there may be 2% of tokens that are utility tokens instead of 1, or 3, or 5, or 10, from the SEC's perspective, remember they're cops, and if you understand their mission is to protect investors, then you can understand that they're going to err on the side of overly pronouncing things to be securities if the consequence of that is to compel issuers to describe their security, to describe the token more fully than they would, and they didn't, when they were selling utility tokens. So look at it as the government, and it may be, technically we can argue around the margins, but practically speaking, the government said, in order to maximize the protection of investors, we're going to tell token issuers that they are dealing in the area of securities, even if they're not selling a share of stock, or even if they're not selling technical ownership, they're dealing with securities. This is the government's way of getting everybody to give more, all the issuers, to give more information to the investors before the investors part with their money. I think that the government is willing to accept the occasional loss in a case that somebody may bring saying, I really am a utility token, but practically speaking, I don't know any of our clients who are willing to be the test case that fights the SEC and prevails saying we're in the 1%. Instead, everybody we're working with now says, got it, we're going to bite the bullet, we're here, we want you to help us write our documents so that we can meet that securities imperative. We can tell investors what they're getting and what they're getting into, even if it is a utility token.
Can I just add,
I'll be that first client.
can I just add one thing to one thing that he's saying? Really, if you just ask yourself on a utility token, if I didn't trade this, if you didn't go into any kind of a trading mechanism and it was only used for whatever that utility, would somebody buy it? Chances are no, because when they're buying that token, they're looking at the trading and trying to make money off of work that's being done by you guys. It's not being used specifically for a usage for that company.
So let's, realizing that you're a broker-dealer, I think there's a lot of, there's a plethora of crazy legal issues in this industry that really aren't being talked about right now, and one of them is broker-dealer issues. So for those of you who don't know, a broker-dealer is someone who is licensed, and one of the things that they can do is that they can take transaction-based compensation. And what we were seeing, especially in the, in the wild days of 2017, was there were marketing companies and advisors and all of these people basically saying, hey, we want a percentage of your total raise, or we want basically something that looked like transaction-based compensation. Can you tell us a little bit of context about what service providers are and are not allowed to do in terms of transaction-based compensation?
Well, if it's a securities, obviously, then you need to use what we call registered, as opposed to licensed, registered broker-dealer that's registered under the SEC. It's very black and white if you're taking a transaction fee. So if you're an issuer and you're out there looking for someone to help you raise money, and it's from some digital, quote, investor that's not registered, and you actually use them to help you find investors and you pay them on a success fee, just doing that can nullify your transaction, which means investors, if they find out or found out that you used a non-registered or entity to help you bring those investors in, can actually make it so that you have to return all the money to your investors. Okay, you're nullifying your transaction by doing that. It's very serious. And one of the things that I was saying and talking to them about was, in this industry, it's kind of like the web. You're seeing a lot of really young faces. And it's just, to me, it breaks my heart when I see these young faces being misled by supposedly people who are experts. They're not securities attorneys. They say they worked for Morgan Stanley for 25 years. They say they worked for, Jefferies, whatever. Well, you know what? Then they should know better. The fact that they are misleading these people and like I said, a lot of young faces, and that are doing business here in the United States. And I think what people don't understand is the damage you can do. If you do a securities transaction and you break securities law, it is going to be a black mark on your resume. It's serious. Go ahead.
So, David, you're the most fearsome person on this panel.
We like him. You know.
So, one thing that people have to be concerned about is the SEC, of course. So that's a federal regulator. Another is, to the extent that they're not using a federal exemption, possibly state regulators. And the third is the plaintiff's bar, right? When you go out and sue these issuers, how do you choose who to sue, and what is the basis of your lawsuit?
So in the last year and a half, I think that's changed, and I think it's going to change again in the next year. But the first group of people, and I don't believe the SEC is following David Silver, but I think if you look at my whistleblower complaints, there's going to be an interesting timeline of when we file the whistleblowers to what the government is doing. I think it's important that you recognize that the SEC has started with the low-hanging fruit. And right now, what the SEC has done in the public pronouncements, there's been no fighting because the companies they've gone after, they haven't fought back. And I think we're going to see this is going to be different with what happened in the last week. So in the last year, for instance, what we've done is we've gone after the low-hanging fruit. If you filed and did an ICO in 2016 or 2017, and you retained Cooley, Perkins Coie, or one of the other large firms, there's a chance you tried to do this legitimately. There's a chance you paid $250,000 to be told you had a utility token, even if you were pre-network. There's a chance that you also paid some of the lawyers on the side a portion of your tokens to do that legal work. We've started going after, and most of the lawsuits are all pre-network tokens that were sold, so there's not really a fight, and most of my lawsuits, while they have confidential settlements that I'm not allowed to publicly speak about, what you can see is the ones that were resolved and got dismissed. Those cases were all pre-network utility tokens that we sued saying they were securities violations. And I think what we were talking about rescission and getting your property back, one of the issues that's going on right now, how do I identify? I only get paid by contingency fee, so I do an analysis. Right now, any person I choose to sue in the space, I'm fairly confident I'm going to get a judgment for. Collectability is something different. So I talk about the red flags. We look for red flags now. If you have two guys that live in Miami, that grew up in Miami, and they do an ICO fundraiser in Russia, and they're still living in Miami, their interests are not aligned with the people that are investing. Their interests are aligned with themselves to get the money away from you when something goes wrong. So we do evaluations right now because, let's be honest here, it's going to be hard to sue the government and plaintiffs' lawyers. We work about 12 to 24 months behind the actual cause of action. So right now with cryptocurrency, 12 to 24 months ago, the price of Bitcoin was $500. The Ethereum, Ether was trading at about 50 bucks. So now that it's worth so much more, the bad guys have moved the money out. So the evaluation on collectability, which is why I think you're going to see in the next couple of weeks, months, with Circle buying Poloniex, with Coinbase announcing today that they hired the M&A person from LinkedIn. We're going to see consolidation in the exchanges, and lawyers go where the money is. And right now, I think the money is in the exchanges, and I think they got a lot of answering to do for what I'll call the first round of the ICO world.
So I have a question for Michael and Dave. Late last year, Cooley, the law firm, put out an instrument called a SAFT, a Simple Agreement for Future Tokens. It's supposed to be a play on the SAFE, which is a Y Combinator instrument to invest in more traditional startups. And one of the theories or legal premises is that they made when they put out the SAFT was, if you have something pre-network, it's a security. But then they went on to make a very interesting conclusion, whatever you might want to call it, which is, once the network launches, then the token might lose its security features, and then it becomes a utility token. Can you tell us, what are your thoughts on that legal argument? Does it hold weight? Do you think it's going to fly?
I personally don't like that argument, but you'd expect that from a guy who makes his living off of working with issuers and helping them draft papers that give full disclosure according to the securities imperative to prospective investors. So I have a built-in bias that says, look, the best way to protect your investors, which is the best way to protect yourself, is to give everybody as much information as you possibly can. And there's this bias on people's part that if it's a utility token, they don't have to say anything. So if the agency changes its position and decides, you know what, really we're going to treat it, even if it is a utility token, as if it were a security nevertheless, and want to see disclosure. If my client has already disclosed, because I advised the client that that could happen, and that they went ahead and worked with us to prepare comprehensive disclosure documents, they're already protected. And they're protected down the road because, as David said, these cases, headaches and then the lawsuits that flow from headaches take years to actually materialize. It's not like in many cases, in some it's different, but in many cases, you don't file papers with the government and have the government look at it and say, you're good to go. In a Reg D, what most of these are going out under, there is a government filing that is pretty much pro forma only, right? The Form D.
Right.
Now, if you're doing an A+, you're going to do a filing with the SEC. They're going to engage in back and forth with you until you get to the point where they say we have no further questions, and you're going to be able then to go out to the marketplace and say, well, we had interaction with the government, and therefore we have more credibility than those who don't, the Reg D folks. But nevertheless, that process is available. Still, what you're doing is the government isn't, even in an A+, the government is only looking at what you're telling it, and it's only able to respond back to you within that context. And if new facts materialize, or if the company says in their offering documents, we're going to do this, and here's all the information about what we're going to do, and then they just don't do it, the government won't know that they won't do what they told the government they were going to do until later. And again, David's point is that it's going to become clear down the road, a year or two or more down the road, so that things were not done as was anticipated initially. So I think what's going to happen is, the best advice that I would give to a client is, it's like prisoner's dilemma. You can only get in trouble, if you believe in God and there is no God, you're okay. And you know how the rest of it goes. And then there's that one case that if you don't believe in God and there is a God, okay, that's the prisoners. So we tell clients, look, if the SEC is going to say, you know what, this is not a utility token, or it's not the utility token, or we're changing our mind on the utility token from last year, we want our clients to be overprotected. So we encourage them, take the conservative route, take the most protective route, for reasonable fees and reasonable expenditure of energy. Protect your investors, maybe overprotect them by making these disclosures, and then you don't have to worry about things at night.
Dave, you you said a couple minutes ago that you're primarily targeting, pre-network ICOs. What's your take on this whole this security can turn into a utility token debate?
So I've been doing a lot of TV lately, so I've learned not to answer the question that was actually asked and give the answer to the question I want. So here's what the answer I'm going to give is. And I think, Sydney, I did this at one of your first conferences I ever spoke at. I looked in the camera and said, if you pay $1,000 an hour to your lawyer, get an indictment guarantee that they're going to stand by their work, and if they don't stand by their work, you should get all your money back. I don't think it was accidental that the head of the Fintech group at Cooley left his job the day before the SEC and the CFTC testified before Congress. There are a lot of people who paid a lot of good money at the early stages to people who claim to be the best lawyers in the business. And they're standing there now holding the bag of, oh my God, the SEC is now going to come after me. So my answer is, I think they did the SAFT. I think the person whose name will go unspoken at Cooley, who endorsed the SAFT and went around the country talking about the SAFT, that
He's wrong.
Not only is he wrong, but he did it to protect himself because he had sold out his clients. And I think you're going to see a lot of litigation related to that. Because if you can't turn around, and there's usually the defense, I paid attention to what my lawyers said. So in the next year or two, we're going to see a lot of litigation where the clients now turn around and look at these large law firms and say, I did exactly what you told me to do. I even paid you 20%. And by the way, how'd they do this? The law firms had their own agreements. The lawyers had a separate consulting agreement that was on the law firm's engagement letterhead that acknowledged the consulting agreement where the lawyers took the tokens separate and apart from the law firm. This wasn't a questionable act.
Right, that's,
Conflict of interest?
This isn't
Majorly,
questionable.
had a breach of the partnership agreement.
So, no, it's not a breach of the partnership agreement. The law firms were aware, because it's on the law firm's engagement letter, that the lawyers were doing this separate from what the law firms were paid.
Wow.
okay, not to mountain onto this, but this is a funny situation because our firm approached Cooley at the very beginning, before we even knew about the SAFT agreements. We wanted to get into the space. We saw that Marco Santori was in the middle of it all. We got on the phone.
We like to call him Voldemort on the stage.
Okay.
Very careful about
Well,
saying names.
okay,
He
whatever.
who shall not be named.
He who shall not be named. Anyways.
The only person who's not a lawyer on the stage.
Yeah, exactly. But we actually took call. We didn't actually speak with him, but part of his group, and we came in saying, look, we think this is a great space. It's growing, but we want to educate. The SEC has reached out to us, smaller broker dealers, and said, hey, please, can you go out there and educate this group of people? They've got a great technology, and they're going to screw themselves over by not following the rules. So we went to Cooley, and we had a conference call, and we explained how we wanted to approach it. We want to do it under SEC, we want to do it under Reg A Plus and D, and we want to follow the rules, and yada, yada, yada. And they, it was a great conversation, and then all of a sudden we talked about not wanting to deal with the tokens and the SAFT agreements, and nothing. All of a sudden, we went from being we want to do business with you, this is great, to not returning phone calls, and we want nothing to do with you. And now it makes perfect sense because they were trying to do this whole SAFT thing and sell this whole SAFT thing, and until it is imploding, I shouldn't say it's necessarily imploding, except for guys like this are going to make it implode. So what we're all trying to say here is please make sure that when you're doing this, that you really get the right kind of counsel. And it's hard to speak badly about other firms. I don't want to do that, but at the same time, dealing with the SEC, they have, like the IRS, some powers that, are, like we said, orange is not the new black. None of us here want to be wearing orange. So you need to really take this seriously and make sure your advisors are giving you good, solid advice.
And to make this positive now, I want to flip this to the positive side. It's really easy to do that nowadays. There's no more questions. It's now clear. You're working with the lawyers and
Right.
working with, we're ICO 2.0. So the people in this room, you're now being educated and the space there's no more rush. I think someone earlier today said, we're going to see a wave of ICOs in 6 months. I think the reason we're going to see a wave at the end of 18, early 19, is because people are waiting to see what's going to happen. So getting good advice now is a lot easier, and working with the lawyers who were conservative before, they're now just seen as the people giving the day-to-day advice.
So I don't want this entire panel to be Debbie Downer-ish. So let's talk about lighter subjects. You know, I talked to a couple of you guys earlier, and even though you guys are, you know, have certain very strong feelings on the whole securities debate, a lot of you expressed that you're very optimistic about blockchain technology. So let's talk about, you know, the token economy, tokenomics for a second. You know, given that a lot of these, a lot of the good, at least, ICO projects are, the way they're tokenizing is they are a company that runs on the blockchain, where it actually makes sense, and their goal is to one day become decentralized networks. My question is, are we dealing with an entirely new asset class? Because one thing I don't understand is, okay, let's say in 5 years, the foundation or the company behind an ICO doesn't exist anymore, but it's still security. Who's supposed to do that reporting for a decentralized network? Are we dealing with something new here?
I'm going to say yes, and even nonprofits. Let's say you have a nonprofit, right? They still have to do the same type of reporting and so on and so forth. So part of that decentralized system, when they set it up, they're going to have the people in place to. If you're choosing to raise money and do it in a market such as this, then you're just going to have to, as part of your plan, to have an ongoing employment agreement with certain people, whether it be auditors or such, to take on that. Because I don't think that's going to go away. Disclosing is not going to go away.
So I say this, I am not a regulatory lawyer. I don't pretend to be a regulatory lawyer. So from my perspective, it's a little bit what the regulations are going to be. I don't care. I'm actually pro-regulation. I think people need to appreciate that decentralization is not necessarily a myth, but it's pretty close to a myth. 99% of cryptos are controlled by 1%, just like 99% of the US dollar is controlled by the 1%. Governments aren't going to allow, I heard someone say, you know, earlier today that, you know, the governments can stop people, they can't stop the technology. That's absolutely true, but there's going to be a centralization of the securities, and there's going to be a mechanism for that to work. You cannot stop the underlying technology. Functionally, it's better, it's more efficient, and the world moves ahead. So I don't think the government can stop the blockchain or the technology. I'm pro the technology. I think securities, stocks, bonds, the blockchain is a perfect example of what could be made better using blockchain. So I see that whole asset class in the next 10 years, the entire movement away from trading as we trade today will move on to the blockchain because it's easier, more efficient, public. And these are things that should be happening. So I do believe that it's going to be in a regulated environment, not a deregulated environment, but there's plenty of good that's about to happen.
I think that, if I could just say, I think needs to be a real separation between the blockchain technology and raising money. And I think that's where the big problem is people are putting it all together and clouding it as one and making it all. If you're a token that's a utility token and you've got really great technology to use that, separate it out and raise your money separate from your technology if there's a way to do it. And I think that's how you're going to be safe. Keep your token and your blockchain technology, which is a great technology, and make sure that it isn't tied into how your money is. If you separate them, then you're not going to have any trouble, following, a Reg D or a Reg A. One of the things I suggest, we want to suggest is that if a token is essential to your platform, that's fantastic. Separate it out. Do your offering as a unit, because here's the thing. If you're just offering a token and it has no real value other than the fact that it's trading and someday, you can use it to play a game, you give your $1 million and now you get to play the game once. Okay, that doesn't make any sense. But if your token it doesn't have anything other than the trading, then what are you really getting as an investor? If you're using the SEC and thinking in terms of that, you're going to get equity or you're going to get debt or you're going to get something for your money other than just some token that doesn't have any value. That's a good thing. That's a good thing for everybody, and that's a good thing for the blockchain community because you've got people now invested in you that want you to succeed, you know, for more than just what is it trading at. They want to see the underlying technology be good technology. So what I say to my clients is, hey, look, if you think you have a great technology that's going to be something, you're going to be a Facebook, you're going to be somebody, do it right from the beginning. Okay? Now, if you're just some Joe Schmo and you're trying to get a quick 10 million and then run off with it or whatever, then okay, do it. Don't worry about it. Who cares, right? But
We agree. I mean, at our firm, we look at the blockchain as it's a delivery mechanism. And the question on that we pose to any client when they walk in the door is, what are you going to use that delivery mechanism for? And surprisingly, that gets really hard for people to understand, and it's because until recently, it seems to me, too many people in the industry were not looking at what they're doing as being engaged in a business.
Right.
Their token is part of their business. The gentleman who did the commercial, not the last one, but the one before that, he made a comment about, you know, what's the token? The token's metal. What's your business?
Right.
And I thought to myself, you know, that's the issue that we go to clients with, and they'll give us a white paper, and we've got to draft their offering documents, right? So we're writing their PPM. You need to describe the business, and they'll describe the token in the white paper and say, that's all I need. And we're saying, well, wait a minute.
where's the underlying
Yeah,
business?
what are you going to do with the token? How are you going to get it out there? How are people going to adopt it? Where are they going to be with it 5 years from now? And they'll sit and think and say, I never really thought beyond the token. That's the business, and if you don't describe the business that's really going to be governing that token, then you've missed what the government wants you to make sure you don't miss, which is explaining to people whose money you're taking what they should expect in return. And by the way, you wanted the optimistic take? I know this is self-serving because I'm a transactional securities lawyer and our job is to write these papers, and of course we get paid for it. You know, we can do our job, maybe because we're a small firm and we're not Cooley or some of the big boys, but we can do our work on behalf of middle-class clients, charging middle-class rates, and do as good a job as the big firm, and have clients say to us, oh, you know, that's an acceptable fee. That's less than I thought it was going to be. That didn't bankrupt me, and the process wasn't so complex that I couldn't actually undertake it. Quite the opposite. It's actually, surprisingly, not brain damage to do securities documents, to explain to people, working with a good team of experienced lawyers, what it is you need to share with your investors, and then you get the double check of the broker who you bring in as a salesperson to augment your sales efforts. As the issuer, they're going to be able to look at the documents and provide additional input. And so that what you're ending up with is a product that describes the investment opportunity in a way that satisfies the government's the government's requirement, and you're going to be able to do that in a way that not only is cost effective and not only doesn't result in brain damage, but then is actually a marketable deal that an investor with any sense can look at and evaluate whether or not it's worth the risk. And that, again, is the whole point.
So I have a question. The SEC has come out recently and said that they consider cryptocurrencies to not be a security, but tokens, a lot of these
Right.
ICOs, to be a security. So really, what is the difference? Because I look at some of the cryptocurrencies like Ethereum, and when they came out, they did a whole pre-sale. What gives? You're laughing.
I did an interview this morning where I got yelled at for that. So I'm going to say, look, if you raised money and you came into it, look, Ethereum should be a security. I don't actually see, Clayton actually didn't come out and specifically say that it's not going to be a token. No one knows exactly what the SEC is going to do. But it's very hard-pressed that Ethereum, which has taken off and is now trading at a 10x for what it was raised at, should not be deemed a security. I think we are going to learn a lot, and this goes back to 12 to 24 months, people. This is why you guys have the ability to learn to do it right and get it right the first time, so that you don't have to be exposed to what the original players who are going to end up sacrificing themselves for. This is no different than Vegas when it got built the first time around. The people who invested in Vegas lost all their money, and then the second group of people who came in made a lot. You guys have the opportunity to now do this correctly, and there's going to be a rush of people in the next year to make a lot of money doing things legally, with compliance, and with the right partners, and that's what people in this room have the ability to do, and do it well.
Can I just just add to it? I think there's not a fallacy, but I think people are starting to recognize that the days of, an elderly Chinese lady, giving her Bitcoin for these ICOs and raising millions of dollars that way, those days are kind of gone anyways. What we're talking in terms of is institutional investors, okay? Most of these deals that are getting done now, their pre-sales or whatever, they've gone out, they're doing the road shows, they're meeting with investors, they're doing all the hard legwork, just like you have to do to get real investors, okay? Mm-hmm. And the investors are there. They like the space, but they want real companies with a real prospectus. They want to know their money is going into something that's legitimate. So, like she said, the happy of it is there's lots and lots of money out there, guys, wanting to be involved in this space. So just, if you have to go beg, borrow, and steal from family members to get the right attorney, the right SEC attorney, I'd love you to give me your money too, but the first thing is get a good SEC attorney to make sure you're doing this the right way.
So I want to leave a couple of minutes for questions. Do we have any in the audience?
I know that this space is new. I'm Andre with Ulala. How do you see broker-dealers or Series 6 or Series 7 having any participation in the blockchain?
So the question is, do broker-dealers have a role in the blockchain industry?
I'm just saying because I did a license through the California State of Insurance before, the Department of Insurance, and in none of the curriculum as a Series 6 or Series 7 tester, is there anything about blockchain because it's so new, so therefore how come Series 6 and Series 7 consider themselves to be
How are broker-dealers, so the question is, how are broker-dealers involved in the blockchain industry?
Well, the blockchain industry is not any different than most other industries. It's a technical industry.
Excuse me, yeah.
It's okay. What were you saying? Though, am I qualified?
No, could you qualify to be able to tell the technology and what it does as a Series 6 or Series 7 licensed person?
I'm not understanding the question. Are you saying would I be able to vet the technology?
Yeah.
Well, no, I would not personally. I'm a Series 7. I know everything from the SEC and that side of it, but we would have technology experts that would look at it and say this is a real deal or not a real deal or whatever. So I wouldn't personally do it, but we would have technology. We have technology people on staff that would take a look at it.
I think you have to keep in mind that what the broker-dealer as a salesman or woman is doing is helping the issuer sell the investment opportunity. And the rules exist regardless of what the particular investment opportunity is. There are some tweaks, although the SEC claims that there aren't, that it's the same old, whether you're doing EB5, we had a lot of experience with that, doing crowdfunding, the rules are the rules. There are occasional variations, but broadly speaking, the salesman and the issuer have a series of obligations under the securities laws, and that is to fully disclose the investment opportunity in whatever field it happens to be in, including the unique technical aspects of the particular offering in the particular field.
And that was the transactional answer, the plaintiff's lawyer answer. I am salivating when financial advisors start selling this stuff. I am salivating. It's going to open up a whole new can of worms for financial advisors who functionally, I've been in this space since 2014. I do interviews all the time about this technology, and I tell everybody, I was a 16th century English lit major in college. I don't look at white papers, I don't understand them, I understand the cryptography, I understand people stealing people's money. That I get. So your question is, eventually people are going to educate themselves and move on. I think someone else had a question in the back.
So the question, I think, is what is the liability to third-party service providers who charged different types of compensation for their services?
It depends on the service. What service were you providing? If you were a writer and you're getting paid for writing, that's not, the SEC is not going to, if you're just, program, no. No, if you were doing financial advising and you were, well, it depends on what you're programming. There's fraud issues, so yeah, right? Yeah, I mean, this is from, but the SEC probably will not come after you.
But that's not the question you asked. The question you asked is, you're gonna have to give the money back. Not who's gonna come after you. Or you're gonna have to give the money back. I'm just saying that if you participate in something and they come and collect the money, they're gonna look to everyone who got the money. Not that you did something wrong. People just can't profit from a Ponzi scheme. So there's, right now, that's a very gray area of people who are participating, but there were a lot of, companies that portrayed themselves as raising money in ICOs that they didn't create anything. That money's all gone, so lawyers try and get money from wherever they can. Sometimes that's innocent bystanders.
Well, hang on, if I can just, I got to respond to that. The SEC has said in the area of crypto, we want lawyers and accountants in the industry. We want you guys leading the role in educating people about their responsibilities and their duties and how to carry things out in this industry. So part of our job, even if we're not going to be directly responsible for misbehavior we didn't know of or sanctions, quibble, 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 okay? The government wants people participating, people like business plan writers, economists, accountants with financial projections. If the end result, and ideally this is the incentive, is to create a better investment opportunity, or at least a more fully disclosed investment opportunity, so that the investor understands what it is she or he is getting into. So everybody gets sued, but if it wasn't the unusual case that people who aren't really responsible end up paying, other than paying their attorney to get out of a case, then people would say, I don't want to be a business plan writer and get near this industry because there's too much liability risk. So people like David, I expect at the end of the day, are really the most interested in the people who are service providers who know about faulty disclosures, who collude in hiding information, who help out, and those people are personally responsible for their own misbehavior, not just the issuer. Whereas if you're an innocent service provider and you're relying on information that's provided to you by the issuer itself, and you're taking that information in good faith and working with it, you can always get sued.
Right.
Because the
Anyone
first
can get
question
sued.
in law school, they ask you in the first class, first day, the first question, who do you sue? You know what the answer is?
Everyone.
Everybody, right? Well, you set that aside because, okay, it's funny, but it's kind of ridiculous in a way. There is some room for service providers in good faith to participate, otherwise they'd be majorly disincentivized not to, and I don't think that's what the government wants.
Right.
Sorry, so I think we only have time for one last question.
But the Jerry will take it. Did you agree? Michael will take it easy on you. That's it.
All right, so
We can get two questions.
two questions? Okay,
Okay.
two
Gentlemen,
questions
then
left.
These lawyers, they charge thousands of dollars.
I saw a hand over there.
This gentleman over here has had his hand up forever.
Sorry, I'm.
Oh, sorry.
Sorry, so, the lady over here.
Mine's pretty quick and easy. I'm just curious, coming from a formerly commercial insurance space, how do you see these companies, their directors and officers liability responding to these types of lawsuits?
How do
The
you-
That's a great
So the
The next-
question is, how do you see D&O insurance or directors and officer liability insurance responding to this space?
So the next D&O policy I see will be my first. So that's the first answer. Lloyd's of London supposedly is going to start writing D&O policies. There's a rumor that Telegram actually got a policy. I believe it's coming into the space, and it's going to naturally occur as it's cost effective for legitimate businesses to get insurance. But I have yet to see, for the first round of this, a single ICO that had D&O insurance.
And I think part of it is just the insurers need to get around to figuring out how to underwrite this type of product. Last question.
The guy in the blue shirt who called on twice.
It does exist.
So my question is about the SAP structures. In this country, some of the largest ICOs that have been done have been run by AngelList. Things like Filecoin and Blockstack and so on raised many tens of millions of dollars using SAP structure. Do you think they're going to have to walk that back too?
So
Or is it just good?
the question is, a spin-off of AngelList, CoinList is a platform that has utilized the SAFT structure for a lot of their offerings. What is going to be the consequence of that?
Well, that's a big unknown, isn't it? I can tell you, though, that the last thing that the SEC came out with last week, they said that they particularly were going to be looking at SAFT agreements, and that is never a good thing. So my answer to that is that chances are the SEC is going to come down on SAFT agreements. They don't particularly like them. They don't make necessarily sense to them because, as we've seen, most of these utilities tokens aren't really legitimate utility tokens. So
I'm gonna have a last question. Amy, if anybody wants to get in touch with you, what do you do? How are you gonna get global do that?
So the question was if anyone wants to get in touch with me, and I'll let the other panelists, answer this question too. If anyone wants to get in touch with me, how do you do that? So, you can find me on LinkedIn, Amy Y. Wan. We're building dispute resolution infrastructure for smart contracts because whether ICO or just a regular smart contract, we're just seeing a lot of terrible coding, a lot of security vulnerabilities, a lot of people who genuinely will need to dispute their smart contracts, and the company name is SageWise.
Stage-wise. So Stage-wise.
Sage.
SageWise, SAGEWIS.
Thank you. Michael?
So obviously, homeyerlaw.com is our website, and you can reach us through that, and we're happy to speak with issuers and potential issuers. Not only do we draft the actual offering documents that disclose hopefully all of the material details about the investment opportunity or what the SEC considers to be an investment opportunity to prospective investors, whether it's Reg D, A+, Tier 1 or Tier 2. We actually had somebody come in and want to do a pre-ICO raise using CF, so it's all interesting stuff. Not only do we write the offering documents, we do speak with issuers about structuring and what is the best way to go, maybe the best way for them to pursue based on what they're attempting to accomplish. So you can reach us. If you didn't grab a business card from me, look for us on the World Wide Web.
And you do have some pamphlet in the table. It's all
Yeah, this is, thank you for reminding me. This is, if you didn't grab a copy, you might find it interesting. This is the firm's chart on the 4 primary areas of crowdfunding, which is also you understand that most token offerings are done through crowdfunding, whether it's Reg D, which is Rule 506C, Regulation CF, or the 2 tiers of Regulation A+. You can see the pluses and minuses of each, the costs, the timing required, resale and non-resale. The only thing that's not on here, and we probably ought to add, is Regulation S, which are sales of securities to exclusively non-Americans. But we can talk about that for those of you who are interested in combining Regulation S and reaching foreign investors.
Thank you. And Connie?
Okay, I'm Kelly. I'm with Ascendiant Capital, and our website is www.ascendiant.com. But if anybody's interested in getting a hold of me or would like contact information, the lovely lady that's sitting back there, raise your hand. That's my IRPR gal. And please give your name and number to her, and she can give you information as well to get a hold of me.
And Michael, if somebody wants to hide from you, what is
Right. Where do they hide you?
So, I'm David Silver. I have silvermillerlaw.com. If you Google any single ICO, chances are you'll see an ad for my firm. So pretty much, or if you Google any exchange, I'm there. But I'm going to close by answering your question. Right now, if you did a SAF, chances are the money you raised through the coins you raised is worth substantially more than what your investors gave you. Since rescissions is on the table, I think many people are going to start finding a way to split the baby in people who gave money in June 2017 with the valuation today. Everybody can win in the situation if they're smart. If they're greedy, everybody's going to lose.
And I want to thank our panel. I'm always grateful to all of you guys. You've been the last 5 years my friend. I always have good friends as lawyers. And and our CrowdFund Beat and also Fintech world, we always bring the best education. It's always investor education. Always we have lawyers that we access to you guys, and everything is in the website, Fintech world. And Again, this is, we have seen it all over again. I've lived in Silicon Valley for a long time, see the frauds and things happen. It did happen in crowdfunding, especially nobody talks about it, the reward crowdfunding. A lot of people raise money on their, Kickstarters, Indiegogo, whatever happened to that coolest cooler, $14 million. Then one of the product is never taken. So be careful whatever you do. Talk to your lawyers, talk to your accountant, do research before you do anything. Thank you very much. Thank you for your audience.
Cool.